Hello my fellow freedom builders and welcome back to the channel. This video of today is made on a lot of requests, and the topic today is all about gold mining. The gold mining stocks have been doing fairly well here in 2020, and therefore I've gotten a lot of questions about if it is time to go for the gold miners now. And I'll not say that it is or it isn't, but I will say that there is some stuff we need to know about mining as a whole before we start investing in it, because it is not entirely like other companies to invest in. It's almost, but there are some aspects that we need to be aware of. So I saw this old quote once. I have read that it is Mark Twain saying it, but I'm not sure really. Yeah, but the guy said, "A mine is a hole in the ground and its owner is a liar." And that of course is not entirely true, but there is some sort of truth to it, because the mining business is a lot about that the owners of the mining companies are telling us that here down beneath our feet is a lot of gold or whatever we want to dig up, and we kind of have to believe them on their words. So today we're gonna dig a bit deeper into it. We're not gonna take this quote as the truth. So I'm gonna show you all about the basics of mining. And here in the beginning it is mining overall, and then we will dive a bit deeper into the gold mining business. And I'm going to show you some very interesting stats at the end of the video, so make sure to hang on to that. Alright, if you haven't done already, remember to subscribe and hit the like button down there, and we will go into mining. When we invest in mining stocks, we have to make sure that we know what it is we are investing in. And mining is, of course, trying to get some minerals out of the ground. That could be gold or silver or uranium or copper or steel or coal or whatever is down there that can be used either for jewelry, for our pleasure, or for some sort of production material in other industries. And now we're looking at gold mine, but later on I will make some videos about some of the other topics, some steel related, some uranium related. But just to make sure, this is what we are aiming for. We want a part of a company that is digging our precious minerals up from the ground. Now, when we invest in mining, there is a couple of layers of extra risk that we are taking on than if I'm just buying into a car manufacturer. Then they have to manufacture a good car, and there needs to be some customers. But as long as the customers are there and the factory can produce the cars, then everything is kind of alright. But we do have an extra layer of risk here, because we have the normal company and or economy risk. And of course, if we are talking about the car manufacturer, then if we have this big virus spreading and nobody are buying cars, then of course that is a risk we are taking. But we are also taking a speculative price risk, meaning that the product we are actually producing or that we are digging up from the ground is not just a normal product. It is a product that fluctuates a lot. And I'll get back to that later under the topics of why mining is not a typical business. But it's just to know that it is not just owning a company. It is actually owning a company, producing a product, and then there are some other people that can send the price of this product up or down like crazy under certain circumstances. So let's have a look at it. What we also need to know is that when we're talking about mining stocks, it's a kind of like talking about two sectors in one. Because when we are talking about the gold minings, we're talking about the majors and the juniors. And the majors are the well-established production companies, meaning that they have been there for a long time. They have proven their reserves. They keep digging up the numbers of ounces of gold that they promised to. They have a good solid management group. They have the good researchers and so on and so forth, and they are producing numbers so you can look at their margins and their cost per ounce and so on. So that is the good secure bet. That is almost like buying a normal business where you know it has been there for 100 years and it'll probably be there for at least 10 or 20 years more. Then there are the juniors, and the juniors are the ones that I most often see mentioned when people are talking about gold mines, because they are what I would call the lottery tickets. New upcoming companies, often exploring new mines, extremely high risk and of course high return. The juniors are often still in the project phase, or maybe they are just starting out their first mine and start digging up the first ounces of gold, but they are often in the funding phase where it is very unsecure ground we are standing on. It is not 100% certain that they will actually start producing a profit. And of course, if we are putting our savings into one of the gold miner juniors, then I would recommend that a lot smaller part of our money goes into juniors than into majors, because juniors are often mines that go to zero or almost zero in value. And then if we hit the right company, the right stock, then it can go up 1,000%. But it is one of these hype or very speculative stocks that we have to be very careful about. So just remember, when we are talking about mining, we're talking about majors and juniors. And if you want good, solid, stable return with dividend payments and so on, we are talking about the majors. If you want to put some gamble money into a stock, we are more often talking about the juniors. And it is not completely fair to say the juniors are all lottery tickets, because there are definitely companies in there that are somewhere in between, on their ways from being a junior to being a major. Because of course, all the majors at one point have been juniors. So some of them are farther in this process than others. So of course, when I start analyzing single mining stock, I will go in depth with where they are in this process. Now, why is mining not a typical company, a typical business? Well, first of all, the earnings depend on commodity prices. So when the gold price goes up, this manufacturer of gold or this miner of gold can sell their product for more money than they might have been able to for a year ago. But of course, many of them have hedged themselves because they know what their cost per ounce is. So they're using the futures market to hedge themselves, so they know quite accurately what they can get for an ounce of gold in a year or so. So just because the gold price goes up, you cannot take for granted that the stock, the gold mining stocks you own will start earning 100% more, because it could be that the next 3 years out in the future, they have locked their price in on the futures market. Another kind of atypical thing is that you can't boost the demand in this business. You cannot really advertise yourself to sell more. Not like the car manufacturer, at least. They can put some fancy ads in on the internet or television or newspapers, and they can show how rich you look when you're driving this car, and then people can go out and buy some more. That is not really the case here, and the boosting of the demand, it is at least not relevant for most of these mining companies. Assets are constantly depleting. What that means is that when a gold mine starts, there is a finite amount of gold on this ground they're digging in, meaning that the project they are running, of course they have some estimates as to in the ground beneath us there are 1 million ounces of gold, and we are planning on digging them out with 100,000 ounces per year over the next 10 years or something like that. But it is a constant traveling towards a mine with no gold in. So at some point the mine will be depleted, and that of course also, if the companies should keep on running, and of course they want to keep on running, they often need funding for new mines. So even they are buying up some of the mining juniors so that they can put it under their umbrella, under their majors umbrella, or they are exploring new mining sites, and that is extremely expensive. So often even the majors, of course they can have cash flow coming in if they have 10 or 20 different mines, but often they go out to look for funding in the billions of dollars of size class here, to simply fund these new exploring projects. It is kind of like some medic pharma company starting on developing a new drug. It is very uncertain when it will succeed, how it will succeed, how much it will end up costing, and so on. So that is something you should take in consideration, that some of them are diluting the stock's value because they're going out offering out new stocks on the market, simply selling more stocks, meaning that your stock will be worth less. So that is a thing to consider. Then I've written here political risk. And that is because, of course, in the beginning, where a company starts, let's say it is a US-based mining company, they are, of course, picking the mining ground that is the easiest to go to. But many of these mining companies are seeing that they're depleting their mines and they have to look outside their country of origin. So they might have to go to countries in South America, in Africa, in Asia. And if you're investing into a mining company that is based in, let's say, United States, and you're thinking, well, that is a good and solid company to invest in, and the government, the politics in the United States are fairly stable. So it could be that if you want to own the stock for 10 or 20 years, then in 20 years it will be a completely new sort of company, because they might have depleted the mines they had in the United States, and now they might own a mine in Peru or in South Sudan or in a country in Asia, somewhere in the world other than the original country. And that means that they often tend to get some sort of political risk as to, it could be wars, it could be countries, governments seizing the mines. It could be all sorts of political risk, and you have to take that into consideration as well. Another thing that is not typical about mining, and that could be a possible thing in the years to come, is that gold mines often give inflation hedge. What that means is that in very inflationary times, it, at least historically, seems like the gold mines are going up significantly more than inflation. And that is, of course, partially due to the product they produce, mainly the gold. It has not really been the case the later years that people have been buying them for inflation hedge, and that is, of course, because there's been no inflation. The last 10 years or so, inflation has been pretty much dead. But in the 70s and the 80s, with extremely high inflation, it was obvious that gold mines could be, or was used as an inflation hedge. Now, when I say that it could be relevant again in the upcoming years, the reason why I'm saying that is, and that is just a little offspring here, that the rate of money that has been printed right now by Fed and partially by ECB in Europe as well, but especially right now the Fed, is immense. It is absolutely absurd, the amount of dollars that is printed. And just in my head, in my common sense and my experience, that tends to lead to inflation. But let's see if that is the case here. That is not necessarily true. All right. A thing that can be good to consider also when investing in mines is what determines the gold price. And there are different factors here you could consider. There is the currencies, and here I'm mostly talking about the US dollars, and we'll look at that in a second, where we look about the correlation between gold and US dollars. But the rule of thumb is that when the gold goes up, when the US dollars go up, the gold is under pressure, the gold price is under pressure, and when the dollar goes down, the gold tends to go up. I'll show you that in a chart in a second. Then there is some factors about economic uncertainty, and right now with the virus out in the world and recessions coming, there could easily be a run for gold, because gold tends to be the safe haven that people invest in. So in uncertain times, there are some tendency that gold could go up, but not necessarily each and every time, and I'll show you that in a second in a chart as well. Then the last thing is supply and demand. And of course that could be private retail demand. In good times there could be more demand for jewelry or whatever, wedding rings and so on. But I'm also talking about geopolitical demand. And what we can see here, I know the numbers are very small, but here we can see the estimated total Chinese gold reserves. And that is, you can have these numbers for all large countries, but right now we're just looking at China here. And as you can see, back from 94 and up to 2019 here, you can see that their gold reserves has exploded in value. And they have their own domestic mining. That is the blue area here. I'm not sure how clearly you can see that. But then we have this brown orange color here, and that is their net import of gold. So China right now are really filling up their stocks of gold. And when we are talking about demand, geopolitical demand here, I'm talking about countries filling up their gold storage. And right now we can see that especially China, and I think it is Russia also, have really been big gold buyers the latest years. China have been selling out of a lot of US bonds, US debt, so they're not the largest holder of US debt anymore, and instead they have been buying up a lot of gold. And there are a lot of speculation as to why that is, but it seems like Russia and China are betting on that that the US dollar will be a lot weaker in the future, and that will pressure the gold upwards in price, and that of course will leave them in a better position, having sold off all their US debt and have bought up all the gold instead. But that is a topic for another video. Let's just have a quick look at some charts I will show you here. First of all, in the upcoming videos, I will go through a number of gold stocks. I have some of them here, but more will come in. And that is in Stockopedia, you know, my favorite analysis tool here for the fundamentals. And in here, I have made a portfolio of the different stocks. You can see out here market cap. The biggest one is Newmont, and then Barrick Gold right after that. They are the two large players, the two majors here, with just around $40 billion in market cap. And then I have them down to some very small down here. Some of them only a couple of $100 million in market cap. So I'll go through a lot of them in upcoming videos where I look at all of the aspects as what I think about the gold sector here. All right, but one thing I think you should see that is important. First of all, here I have a chart in TradingView where I have gold. That is the gold we have here, the blue one. And then we have the S&P 500, and we can see it back to 98 here. And you can see a percentage as to how it has been going up or down. Now, if you don't know it, in TradingView, if you have one line, if you have, for instance, gold, and you want to add another, you just have to here compare or add symbol, and you can type in any symbol or commodity or whatever you want, and you can compare them in one chart. That's quite neat. Now, many people say that the gold and the stock market are inverse correlated, meaning that when one of them goes up, the other goes down. Now, if we look at this chart, it is not necessarily so. Here we can see back in just before 2000, we can see that the stock market is going up and the gold may be dropping a bit, but at least over some time going flat here. So it's basically not moving much, whereas the stock market is going up and going down. So it could have been an okay hedge, at least here in the time where everything went down. Then we have from around 2003 down here, 2 down here, and then 5 years ahead here, we are actually seeing that they are moving pretty much the same. So there's no inverse correlation here. It's not so that when the stock market goes up, the gold drops. Not at all. Then, of course, we have the financial crisis. And at that time, well, the gold did go up, but it was already in a trend. So it is not really fair to say that it is because the stock market went down, the gold went up. It would have been an okay hedge here. But then we have from March 2009 where the market turned and pretty much went up in a straight line from here. In that time period, we had up until 13, a very nice move up. Then we had a move down. Then we have up and down and up and down and up here. While the stock market pretty much, of course there are some waves in here, but there's not really anything here that tells me that gold and the S&P 500 are inverse correlated, because it's not that I can see that when one goes up the other goes down, and when the other goes down the other goes up. It could have been nice, because then gold could be this sure hedge that we could go to every single time that we thought that there was some uncertainty coming into the market. But it doesn't seem like that, does it? But there's something else that might be a better indicator. And let's see here. I have on the Macro Trends website here, they have a ton of nice charts. And here we can see gold price and US dollars correlation. It is just over 10 years. So of course we cannot put a lot of meaning into it when it's only 10 years. But it seems like the correlation seems to go on also before. And we have here, yeah, we have actually back to 1995 here. So it must be for the last 20 years, to be honest. Anyway, here we can see that we have the S&P 500, and we have we have the US dollars, and we have the gold. And when we're looking at these two charts, they are actually inverse correlated. When one goes down, the other goes up. You can see the gold is dropping here towards the year 2000. The dollar is going up. All right, at the top here, we have the top of the dollar, we have the bottom of the gold. And now they're moving in opposite directions. They're crossing each other. And when gold is going up here, making a new high, well, the dollar is making a new low. It makes the same move again with a low and a high, and then it reverses again. But every single time, pretty much, we have a movement in one direction. The other, when the dollar is moving down, the gold is moving up, and so forth. And it happens pretty much every single time. So the correlation between US dollars and gold is actually very strong in a negative direction, meaning that they are pretty much moving in the opposite direction each and every time. And this is, as I said, it was more than 10 years. This is back from 1995. I'm not sure why it says 10 years up there. And we have it up until December 19, so it's actually 25 years here. And that is very interesting, because it might not really be a hedge from the overall market when the market drops, but gold could be a hedge if you are heavily invested into US dollars. Then gold is an okay hedge to have, because it goes up when dollars go down. One of the reasons for that is that and normally gold is measured in dollars per ounce. So the overall, most normal at least, measurement of price on gold is number of dollars per ounce gold. And that means that when the dollar drops, you would have to pay more dollars for 1 ounce of gold, because going for that the gold is at a standard value. Then when the dollar is dropping in value, you would need more dollars to pay for the same amount of gold, and therefore the gold price measured in dollars goes up. I hope that makes sense, but that is how it is constructed. So that is one thing that is interesting here. Dollar and gold is negatively correlated. Then I have the last chart for you here. And now we are talking about gold mines. So here you can see the US dollar currency here, as we saw before. And now we're not looking at gold, but I have set it up so that we have the GDX, the Van Vectors ETF Trust Gold Miners. So that is an ETF covering a lot of the large gold miners. And you can have a look at these and see if you can find some of the same negative correlation here, and there actually is. We could also try and see if we look at the gold miners here, and then instead of the DXY, which is the dollar index, we could put the SPY in here, which is of course the S&P 500, and we could see if there was anything we could learn from this. And what you can see here is that if you want to buy gold miners, or at least this gold miner ETF, as a hedge for large drops in price, well, let's see how far we can go back here to see if we can get some of the, you can see it has had a hard time, the gold miners here. We can go back to the crash in 08 and we can try to do the same down here if I can get them aligned. Here we go. All right, so what you can see here is actually that the gold miners start to drop at the same time as the overall market. Then the gold miners go up, the market go up. Then the gold miners are getting into a slump here due to prices, gold prices, etc., and low inflation also. So they've dropped very low down here. The S&P 500 just keeps chugging up here. But every time we see a big drop, or almost every time we see a big drop in the S&P 500, we also see it in the gold mines. So just recently, we can look at the pricing here. Let's see if we can get them aligned here. We can see that this big drop in the spring of 2020 here, we had pretty much the same drop. I'm not even sure in percentage how much it was. In the gold miners dropped 40% here, the ETF at least, and the market dropped 32%. So if you want to buy gold miners as a hedge to for potential drops in the stock market, then this doesn't seem to be the right way to do it. Or at least you have to be better at picking specific gold miners instead of just a broad gold miner ETF. So that is about the topic for today. We were looking at what the gold mining were actually about, what the risks were, that there were majors and minors, and we were looking at why it was not a typical company. And what we have seen in the chart is that gold and the stock market is actually not negatively or inverse correlated. Gold is much more negatively correlated with US dollars. So if you want to see if gold should go up or down in the long term, you might also be analyzing the DXY, the US dollar index, because that is actually a better indicator. If the DXY is going down and the gold starts to move up, then you might be more certain on a direction than looking at the stock market. So it is kind of a myth that stocks and gold are moving in opposite directions, but as we can see here in the charts, they are actually not in to an extent where we can use it to anything in our investment decisions. So now I hope you followed me to the end here, because I think it is important to understand the structure of mining when starting to put some of your money into it, because it is a bit different than owning just normal stocks. There are a lot of extra commodity risk put into these stocks, and they're also often very heavily they have heavily borrowed money to fund their new projects. So there is the loaning risk, the interest risk, and there is a commodity risk, and that is definitely something that you should consider when moving into this sector. That's all for now. In next week, I will come out with my first video with 2 or 3 of the major gold companies, gold mining companies, and we'll look at some of the juniors later on as well. Remember to hit the subscribe and the like button down there. I'll talk to you again soon. Take care of yourself and your money out there. Bye for now.